Have you ever seen $1 trillion vanish and reappear over a weekend? Welcome back. I'm your host, Evelyn, and today is Monday, June 8th, 2026. The stock market is suffering from severe whiplash today. Last Friday, Wall Street hit the panic button on artificial intelligence. Big players aggressively dumped high-flying semiconductor stocks. Everyone screamed that the AI bubble had finally popped. Fast forward to this morning, and the narrative has completely flipped. Tech giants are roaring back to life with massive gains. The Nasdaq is suddenly surging as buyers rush to grab the dip. We are going to unpack exactly what is happening under the hood. You will understand why smart money is playing a totally different game right now. Let us start with the tech sector rotation. The massive sell-off last week was not a sign of fundamental weakness. It was a classic, aggressive rotation by institutional investors. Money managers simply decided to take their massive profits off the table. They cashed out of chip leaders like Broadcom and Nvidia after spectacular runs. This capital did not actually leave the stock market. It just moved into safer, ignored corners of the economy. We call this a healthy reset for a robust bull market. The underlying infrastructure build-out for AI data centers remains absolutely incredibly strong. Corporate demand for next-generation memory and computing power is not slowing down. Valuations were simply stretched too far, and gravity briefly took over. Today's dramatic rebound proves that the AI growth story is far from over. We are already seeing aggressive buying in major chip producers like Micron and Marvell. Nvidia is back in the green after announcing a massive new memory partnership. The market simply could not resist buying these companies at a significant discount. Wall Street loves a good panic, but it loves a bargain even more. The real test for this renewed tech optimism arrives later this week. Oracle is preparing to release its latest earnings report on Wednesday. Investors will dissect every single word about their data center spending plans. If Oracle shows any hesitation, this tech rebound could evaporate instantly. Keep your eyes glued to those corporate infrastructure numbers. Meanwhile, a massive geopolitical storm just lost most of its destructive power. Over the weekend, global markets were absolutely terrified by escalating Middle Eastern tensions. Crude oil was rocketing toward a dangerous $100 a barrel. Higher oil prices are pure poison for consumer spending and corporate profit margins. However, Iran unexpectedly announced an end to its latest military operations against Israel. This sudden de-escalation acted like a massive pressure release valve for the global economy. Oil prices immediately dropped back down toward $90 a barrel. This geopolitical relief gave stock traders the exact excuse they needed to buy. The fear of a sudden energy crisis is officially on hold for the very near future. Despite the tech rally and cheap oil, a quiet monster is still lurking. The bond market is currently sending out major distress signals to stock investors. The yield on the 10-year Treasury is creeping higher and approaching dangerous levels. This indicates that big bond traders are still terrified of sticky, persistent inflation. We have critical consumer inflation data coming out later this very week. If those inflation numbers come in hot, the Federal Reserve will completely freeze. They might even be forced to shock the market with another rate hike. High interest rates are the ultimate enemy of expensive, high-growth technology stocks. You must balance your enthusiasm for AI against this heavy macroeconomic reality. So, how do you actually trade this chaotic environment without losing your mind? You must stop chasing daily headlines and focus entirely on long-term corporate earnings. The companies building the physical infrastructure of the future will continue to win. Use these sudden, violent market dips to accumulate shares in dominant tech leaders. However, you should also keep enough cash on hand to survive inflation shocks. The rotation we saw last week will happen again as interest rate fears fluctuate. Stay deeply focused, ignore the emotional noise, and let the panic of others serve your portfolio. Thank you for tuning in to our latest market analysis today. We will continue watching the tape, so you do not have to.